In order to talk about tax, I think we should start by just discussing very briefly how tax works in the basic unit trust. We can then compare the other vehicles and say, well, how do they differ? So in a basic unit trust, you pay two kinds of tax. You pay income tax and capital gains tax. Income tax is basically any income you earn from that investment is added to your other income that you might be earning, and you pay tax on that at your marginal rate. Just some important nuances. If there's interest income, then there's a threshold, there's an exemption, and so the first amount is not taxed. But any interest income over that point is taxed. Second thing to note is that it doesn't matter whether the income is paid to you and put in your bank account or whether it's reinvested inside the unit trust. If you earn income, you pay tax on it. Okay, so it isn't about the income you take out. If you reinvest that income, it was still declared, it was still earned in your hands, you still pay the tax. Okay? And then dividends are taxed at a low rate because those dividends are declared out of after-tax profits that companies have earned. They've already paid tax. You've got to pay another 15% tax. That's not the only tax you're paying. You're paying actually tax on the profits the company earned. So that's income tax. Capital gains tax is incurred whenever you actually sell units. Now, selling units, again, isn't necessarily meaning that you've got money in your bank account, because you could be selling units by doing a switch. So if you change from one investment vehicle to another and you say, oh, I'm not so sure about investing in this fund, I'm going to move it to this other fund over here, you've sold units in the one fund and a capital gain will be calculated. Okay? If that gain is more than 40,000 Rand, you'll pay tax on it. But you don't pay tax on the full gain. You pay tax on the amount that's included in your tax return, which is 40%. So 40% of the gain is then taxed at your marginal rate, which means if your marginal rate is 41%, then you're taxed at 16% because it's 40% of 40%. Right. So that's where capital gains fits into the picture. That's all very well, but I think it's useful to just say, well, how big a deal is that? And so what I've done is taken the actual return in the balance fund over the last 10 years and said, well, how would the return you would end up with in your hands compare to what's on the fact sheet? So if we look at the fact sheet, you'd see that over the last 10 years, the balance fund has returned 13%. Roughly 2% of that has been from the interest and dividends, so that's the income yield of the fund, and roughly 11% has been from the capital gains of the shares in that fund. So you've had a capital growth of 11%, and you've had annual income of 2% to give 13%. And the tax impact of that would actually be different for everyone because it depends on your marginal rate, it depends on your other income, it depends on how much interest exemptions you've used up, and also it depends on what other capital gains you make in the year that you sell the units. Okay. So the illustration I'm going to put up is the worst case. This is for a high tax rate payer, someone who's paying 41% on their income, and who's already used up all of their interest exemptions and capital gains allowances, so they pay tax on everything. So we're going to put up the worst case scenario, and then depending what your tax position is, you would fit somewhere between the zero taxpayer, which is what's on the fact sheet, and the worst case scenario. And this is the difference over the last 10 years. Okay? And so if you look at the returns, 13% per annum is what's on the fact sheet. In your hands, once you've paid the tax, you've actually got just under 11%. So 2% per annum has been lost to tax. And just to tie that back to what Tamarin was sharing, that's more significant than timing the Rand. Okay, so the tax really matters. 20% of your value paid to the taxman after 10 years. And you'll also note that the gap grows because of the compounding effect with the capital gains. So the longer you run the example for, the bigger that gap becomes. And so for a very long-term investment, you can be giving up a very significant proportion to the taxman.